What's up, everybody? Welcome to another edition of the Free Toaster News Pod. I'm your host, Carlos Caro. I'm here with Toaster co-founder Nick Madrid. This week, we're excited to share some of our findings from the NerdWallet Q2 earnings release. If you've been following us for a little while, you know we're always eager to see what they're up to, what we can learn about the affiliate market in general. And this week presented some interesting insights. So we got some clues as to the direction of where they're focused across their verticals, how they're reacting to AI, and some of the disruptions we're seeing with the LLMs coming in. Nick, I know you went through the press release, the call transcript, and some of the sell side notes. Can you give us some of the headlines?
Yeah, so let's start with the headline first. Revenue came in at 197 million, up 6% year over year, and that ended up beating Wall Street's expectations. Adjusted earnings per share came in at 6 cents, which was around 68% below consensus. Yet the stock went up, which was kind of interesting to us. Last quarter they beat and the stock got hammered, but we're a marketing show. We're not an investing show, so let's stay in our lane on this one. But for us, I think the part that matters for this audience is that the sources of growth rotated. So, consumer revenue was about 175 million, up 8%. And on the call, CFO Jun Lee said that this was, quote, driven by personal loans and deposit accounts as consumer demand remained strong and financial institutions expanded budgets. Then came the other half of the sentence, which was, quote, partially offset by a decline in consumer credit cards, primarily due to continued organic search headwinds. So personal loans and deposits are up, credit cards are down again, and SMB was also down around 11%. So same marketplace, very different outcomes depending on what shelf you sit on.
Yeah, no, and embedded in that, and I know we're going to get to it a little bit, were some really strong clues that they're going to be leaning into insurance quite a bit. So I know we're going to cover that later. But we did find 5 key takeaways as we looked through the call and what they put out after the earnings report. We're going to get to those, but before we do, we want to thank one of our sponsors, Spinwheel. So Spinwheel is an API for consumer debt. They offer real-time verified debt data and payments, connected with nothing more than a phone number and a date of birth. So if you're a lender, that means cleaner data for underwriting and a lot less friction in your application flow. Conversion is going to be a big theme of today's episode. So that fit between our sponsor and today's content's almost comically aligned, but it is what it is. If you're interested in learning more about Spinwheel, check them out. They're at spinwheel.io, and we'll put a link in the show notes.
All right, the takeaways. And we're going to go a little out of order from what we published in the note, just because the story, I think, sounds better. So starting with the first one, every card marketer would find important. Credit cards fell another 8.6 million year over year. The press release language is worth hearing in full. The decrease came from, quote, primarily due to continued pressures in organic search traffic that have persisted for multiple quarters. We've heard this before, Carlos. We keep talking about it. Persisted for multiple quarters. The former flagship business is now a declining category, and neither the letter nor the call offered a turnaround plan for it. At least we didn't find one. So Carlos, if you're running acquisition at a card issuer, what do you do with that?
Well, I mean, I think at least for now, until we get a narrative on what they're going to do about it, which I assume they're sharing that with their partners. It's probably too in the weeds for kind of an earnings call, so it's probably a little bit out of context. But I assume they do have a narrative on how they're going to turn the card business around. I think it's too big. It was historically their cash cow, number one business. My gut is that they haven't given up on cards, but that they're going through a moment here where things are challenging. If I were to imagine what I think it's like in their operation, their SEO traffic continues to come down. They've talked about that publicly. So the people that used to, or the teams and the operations that used to put out content that would feed those Google algorithms are now buying paid ads. And that might be in Facebook, that might be on Google itself. That's probably all over the internet, but that's a materially different game. That's a math game. So they're trying to find just the right ad to buy at just the right price so that they can turn it around and sell it to one of their partners at just enough revenue. So it's an arbitrage mathy game, and I think it sits a little outside of the core competency they build over the years on writing really good content around rewards and how to hack miles and all this stuff that like drew in a lot of credit card nerds. And I think their word nerd wallet probably is a bit of an homage to kind of the audience they serve. So I think they're a little bit out of their lane, at least based on their historical competencies. I bet they're getting better every single quarter, but it's probably also really crowded because there's lots of other publishers that lost their traffic on SEO. They're all bidding there too. The lenders are bidding there. My God, I'm betting the CPCs are way, way higher today than they were a year ago or 2 years ago. So it's a tough game. And um, even if they were good at it, and I assume they'll get great at it, the margins are going to be thinner here than there'll be in when you're able to drive traffic through SEO, where the cost on the margin is nothing, right? So um, to your question, Nick, on what would I be doing if I was a card issuer, I would ask NerdWallet to see if they have some kind of guidance on how the card business will look. Like, what will the shape of that be over the next couple of quarters? Because as a head of partnerships or as a head of marketing, I need to know how many accounts are coming from this channel so I can forecast and I can get budgets. And right now, I would be inclined to draw just kind of a downward sloping line, but maybe that's not right. Maybe they see an inflection point coming. Maybe they know when it's going to turn around. So I would ask for some clarity there on their forecast. And as a marketer, I would also be really interested to know, is my decline that I'm seeing in that channel, is it proportional to the market? Or am I losing more than the market, less than the market? I'm really trying to hone in on, am I gaining or losing share in this channel? Because as a marketer, that's ultimately like what I control and like what I can do something about. I can't control a publisher's like top line traffic, but I want to make sure I'm earning the right share of that traffic over time. So that would be the thing I would try to poke on. But Nick, look, it wasn't all bad news in the release. They did see material growth on loans. Can you talk a little bit about what you saw there?
Yeah, so that was actually takeaway 3 from our published edition. Personal loans revenue grew 12.3 million year over year. And the press release says it because they, quote, expanded our marketplace offerings to serve a broader range of borrowers. And I think that's the key there, broader range of borrowers. In the edition, we read that as an expansion into subprime. That's our read. The release never used that word. But a broader credit box plus the volume growth Tim Chen described on the call, points that way.
Yeah, yeah, no. So I think this takeaway is probably more for the personal loan folks, especially if you're in subprime. To me, this was pretty clear signal that they're opening up their buy box. So I think when I think NerdWallet, my mind tends to go prime audiences, people that want to get the Chase Sapphire Reserve, the Amex Platinum, kind of affluent, kind of higher end of the spectrum type consumers. NerdWallet said in pretty clear terms that, at least in the personal loan business, they're looking full spectrum. So prime, subprime, near prime. I think this is a little bit of a pivot, at least in the last couple of years. So if I'm a subprime personal loan lender that hasn't established a partnership with NerdWallet, this is a perfect time. The ecosystem's growing. It seems like they have some traction here. So I think that's one takeaway. The second one is because of this dynamic with their pivot away from SEO and towards paid media. I'm going to imagine that the partners they're willing to work with, it's going to be a more limited set. So only the best converting partners, I think, now can compete. When you run an SEO led business, you can get traffic to a page and you can list 20 publishers, and it's fine because you just need a consumer to pick one of them and hopefully convert. When you're buying the traffic, it's cutthroat, like we talked about, and if you're not confident the lender's going to convert and approve, it gets much scarier to buy the media. So I would be bringing your best conversion, your best converting funnel, maybe your best converting product to the table. But Nick, maybe we poke on this a little bit on kind of the direction of their sales and marketing spend.
Yeah, and this is where I think the whole quarter, comes into focus. Sales and marketing spend hit 145.4 million, up 14% year over year against revenue growth of 6%. Their non-GAAP operating income margin nearly halved from 11% to a year ago to 6%. And we flagged this dynamic earlier in our Q1 earnings edition. And Morgan Stanley also put out a note on August 7th that helps put numbers on this. And I want to quote it directly because I think it's important. So, and I quote, NerdWallet grew revenue 10 million year over year on 17 million of incremental sales and marketing, which took, quote, S&M to 73.7% of revenue from 68.5% in Q2 of 2025. While performance marketing grew 26.5 million year over year to 116 million, or around 60% of revenue, and 79.8% of total sales and marketing. So a year ago, those figures were 47.8 and 69.9. Their conclusion, and again, I quote, is sustaining growth may require structurally higher spend as organic distribution erodes. That's their biggest concern with this entire business.
Yeah. And Nick, that was a lot of numbers. I know we published them in the newsletter. So if you had trouble following all of that, there is a printed edition. You can check it out at thefreetoaster.com. But the two numbers that kind of stood out, Nick, when you walk through that, like if we start to think on an incremental basis, they spent 17 million incremental sales and marketing dollars to bring in 10 million incremental dollars of revenue. And I think that's the troubling part about all of this. Like if you're an investor, if you're someone watching from the outside, you're like, that's not a great return on ad spend. And I think that was the opportunity that Tim Chen took to really start to contextualize their strategies here. And they're saying, look, I'm trying to find his quote. But the gist of it is that they're going to start underwriting multi-year paybacks in their marketing. That was the language he used, like multi-year paybacks. And I read that as we're going to start leaning into the insurance business, because their insurance business, I assume, is set up as an agency. I assume it's set up in such a way that when they refer business out to carriers, they're getting paid not as an upfront bounty like they do in the lending world, but they're getting paid over time as annuities, maybe as a percentage of the premium, something like that. So that was the thing I heard of, like, wow, we're going to lean into insurance quite a bit more. Nick, I saw you had Morgan Stanley notes that talked about unpack this a little bit more. Can you walk us through that?
Yeah, so that the arc of the story is like, in February after the Q4 earnings report, Morgan Stanley had NerdWallet, at a 14% price target. And in the note, it titled "Delivering Near Term with Questions on the Long Term." And a friendly reminder, as of today, as of right now, it's trading around $10 a stock, $10 a share. The question back then, and again, I quote, is whether performance marketing revenue will grow faster than the organic search decay, and what the long-term profitability implications are. Look, we just talked about this. You just said that like a minute ago. But that was said back in February. So clearly they've been looking at this for a while. And the same note flagged that there are, quote, components of NerdWallet's business that LLM providers seem to be servicing already. Then, so that was back in February. Then on March 13th, they downgraded the stock with a title that gives the thesis away, right? And I quote, "Profitable growth looks challenging in the age of AI." And now fast forward to today, in August, they trimmed the price target from $9 to $8. Again, friendly reminder, it's trading at 10. So over 6 months, the question hardened to more of a thesis, perhaps. And every note seems to anchor on the same metric: performance marketing intensity, quantified a level deeper each time. And so what the street wants now, what Morgan wants now, what investors want now is just actual proof, right? And I think this is an interesting point because this was talked about in the in the earnings transcript, and like in kind of outlining what they're spending on and the framework they're using. And in Morgan Stanley words, the company, quote, has not publicly disclosed its IRR hurdles. So if you read the transcript, it talked about the spend they're doing. They're now framing it in a way of an IRR, ROI. And so it expected the payback periods, realized cohort return. So basically NerdWallet is using these new frameworks, these new metrics, but they're not disclosing any of what those metrics are. There's no transparency into that. And they're valuing it at a, quote, discount to peers until more evidence of payback manifests. So it's a very long way of saying NerdWallet's using a different framework, but they're not describing fully what that framework is.
No, and it's there's a little bit of irony to this too, because their business model and like their run up to being a public company and kind of in the good old days when they were growing, double digits year over year, was that they would they spend $1 today and make $1 back tomorrow. It was like a very, very tight connection between investment and payoff. And now they actually look more like lenders, right? Because lenders buy inventory from them, and these credit card accounts take 5+ years to pay back the investment. And now their business is looking more like that, right? Where they have to spend money today, but they're going to be building annuities over time. So that 17 million, back to the incrementals we talked about earlier, they spent 17 million to generate 10 incremental in the quarter. Maybe they could have said this more clearly on the call, but I think what they're saying is, like, we spent 17 million, we got 10 million on this quarter, but like that's going to generate cash flows for many quarters to come because it's insurance annuities and it comes from the insurance agency. So I think what you said, Nick, earlier around how Morgan Stanley is kind of viewing it, they're probably saying, hey, pretty big pivot. We're not really going to react here until we get some real data. And since they're so early, there's not much to go on. But this, I mean, we're talking around the big pivot here, which seems like they're very serious about insurance. I'm not sure if that means that they've given up on lending and cards. I'm not reading it that way personally, but they are spending a lot of real estate in their earnings and in their talk track talking about insurance. But I think the CEO had a really interesting quote at the top of the press release. Nick, do you want to walk through that one?
Yes, and I quote, so this is Tim, we're reaching an inflection point in our business. The success of our vertical integration strategy now gives us the conviction to make incremental investments underwritten on a multi-year payback with compelling returns. We expect to grow this incremental investment 5-fold in 2026 versus 2025 as we deepen our owned audiences and build durable, direct relationships with our customers. And, he opened the call in the same way. So we're in the middle of an AI transition, I'm quoting, that is changing how people get their answers to their money questions. And then William Blair pushed back on the payback math. And then CFO June Lee described it as, quote, ultimately an LTV to CAC optimization over a longer period of time while using IRR and payback period as guardrails. So, the guidance quantifies it. $15 to $20 million of this year's operating income impact is acquisition spend with paybacks beyond the current year, about 5, and at a level about 5 times last year's level.
Yeah, no. So I mean, our read. So these are going to be our words, not theirs. It looks like insurance, the insurance agency business, is going to be their focus because it pays annuities over time versus the one-shot payouts that I used to get from cards and loans. Why you should care? So if you're in those lending categories, I think you need to start wondering what their plans are to kind of get the growth back into those categories. Again, I don't think these earnings calls are the right forum for them to talk about it. So I don't read the absence of a plan for cards or loans as the absence of a plan to their partners. I'm sure there is a plan. But for one reason or another, they're not talking about those plans publicly. So if you have direct access to their teams and you have a working relationship, those are probably the right channels to have those conversations. But I would be personally curious what tack they're taking. Are they going to become an AI native publisher? Are they going to go more the route of Karma, where they have models and a logged in experience? Are they going to triple down on? Are they going to come back to content with a bet that it's going to surface within the L? There's a lot of different roads here that they could take. Um, and I do continue to believe they have one of the best brands in the consumer finance category. So it feels like they have some real assets, not only on the brand and consumer side, but also on like the supply side, all the relationships they have with the major lenders. So they have the DNA to do something really cool and interesting, given this transformation that's happening in consumer finance. It's just not clear how they're going to play it. Um, but Nick, there were a few other quick hits that we got out of that. Maybe we go through those before we close out today.
Yeah, here are a few of them. And one of them was deposits are booming, right? Consumer revenue got a close to $10 million lift from deposit accounts as partners expanded budgets. That was per the release. And I know you could probably share a little more about what you're seeing on the deposit side as well at NMG. We've talked about it before, but insurance has steadied, but it hasn't fully recovered. So Junli said that the largest auto carrier relationship has, quote, stabilized, but not yet returned to levels seen a year earlier. And that carrier concentration issue is really what tainted the stock in Q1 of this year. SMB is still shrinking, down 11% to 22.1 million on the same organic search declines. And then the one I particularly find interesting is LLM traffic. And Tim Chen on the call says, quote, the traffic is converting well. I mean, I think intent is extremely high when someone is coming through an LLM. In terms of wanting to transact in the marketplace, it continues to be a pretty small part of our business today, but it's definitely an area of investment and growth for us. So high intent, low volume for now, which we've talked about before, we're seeing, but it's important because we're going to keep a pulse on this because we find that so interesting, this intent moving to LLM.
Yeah, no, it's something. I actually just had a conversation with a guest that's going to come on the show. I don't want to spoil the surprise, but I had a really good discussion with a practitioner who's in this space just about that specific thing. But a couple comments. So on the deposit point, I had a fairly sized bank to approach me within the last 30 days. And I just thought I showed up to like the wrong call or something. It was just like I felt like fish out of water completely. They were like, oh, they were walking me through what they do as a bank and their deposit strategy, and then they asked me for help to build their affiliate program and deposit. I was like, time out. I know next to nothing about this stuff, guys. I'm sorry. I'm in lending, and they're like, no, we know, but we think maybe there's enough cutover. And I was like, I'm not the right person. But just it was like a little micro data point of some signal that the banks are starting to think about how do they expand what they're doing in deposits, specifically in the affiliate channel. And at first blush, I didn't actually think much of it, Nick. But when I saw the NerdWallet point, I was like, okay, there might be something more. There might be something bigger going on there in the industry. So I thought that was interesting. And then on the whole point around the LLM, there was a question I think one of the analysts asked on the earnings call. That was pretty interesting. Did you want to recap what they said?
Yeah. So Michael Infante asked, and quote, how much of that value do you think that ultimately accrues to NerdWallet versus the platforms versus the LMs? And Tim's answer was a bit on brand. I think brand and reach are just an incredible asset. I mean, I think distribution is so important in this future state of the world. A lot of it is left to be determined. Carlos, you mentioned brand, Tim mentions brand. When the front door of consumer finance moves inside an LM, somebody still gets paid for the shopper. I think the question is, who is that? Is it the publisher? Is it the platform? We probably think it's still unsettled, but that is the question that's going to be so fascinating to watch.
Yeah, no, I totally agree. It was a theme that came up in this podcast that I just recorded this morning. And well, I'm not going to spoil it because I have this guest take on what's going to happen, but I'll leave that as a cliffhanger for listeners of the pod. Okay, but on that topic, there's a lot changing in consumer lending right now, particularly as it pertains to distributions and how AI and the chat agents like the Claudes and the Chat GPTs of the world are going to change our ecosystem. We're going to be exploring questions like that at our summit. So it's called the Affiliate Marketing Summit for Lenders and Publishers. We're going to host it on September 23rd in San Francisco. We have just about 50 seats left at the forum. So if you are a leader either at a publisher or a lender, now is a great time to secure your seat. You can do that by going to events.thefreetoaster.com and just letting us know your LinkedIn profile, because that way we can establish you at one of the lenders or the publishers. We can validate that you're a leader in the space, and we'd love to see you there in the room to discuss stuff like this. So should we do a quick recap before we sign off?
I'll be quick. All right. Cards fell another 8.6 million, and the bleeding hasn't stopped. Personal loans grew 12.3 million, and our read is subprime expansion. NerdWallet is redirecting investment towards insurance and multi-year paybacks. Sales and marketing is growing faster than revenue, so expect conversion rate scrutiny in every renewal conversation. And deposits are booming. Insurance is stable, but it's off its highs. SMB is shrinking. LM traffic, high intent, low volume. And you said it at the top. This quarter, the AI search shift showed up in dollars and in the income statement. So if you buy distribution from NerdWallet, you should feel those dollars in your next negotiation.
That was a great recap. That's a lot to chew on in just a few sentences, but I think it accurately describes kind of the headlines. So if you enjoy breakdowns like this, definitely subscribe to our newsletter. We publish weekly on earnings report like NerdWallet, but also just news that goes on in the industry. And if you enjoy this pod, we publish this usually 6-7 p.m. Eastern on Fridays. Catch it sometime over the weekend. Catch it on the morning commute, Monday mornings. But we'll see you here next week, Nick.
Thanks, Carlos.